Good morning, everyone, and welcome to everyone joining our webinar this morning. My name's Ashley O'Callaghan-Smith. I'm one of the Associate Advisors at Apollo Private Wealth. Now, we're a senior partner practice of the St James's Place Wealth Management Group. We work quite extensively with senior high net worth professionals throughout the UK and across a variety of different industries, and essentially offering them holistic financial planning and investment advice. Now, today we're going to be discussing a topic that I think is becoming more and more relevant in an interconnected world, and we tend to come across fairly regularly in our day-to-day activities, which is UK financial planning for non-domiciled individuals. Now, this is an area which can be a little bit daunting to approach head-on, and especially given the amounts of rules and regulations that exist, not only in the UK, but also the country of origin of many of the clients we speak to. We often see that without proper consideration of the rules and all the factors, then there could be a few nasty surprises lurking around the corner. So the goal of this webinar is essentially to shed some light on a few of these areas that we tend to come across more regularly. And although we do encourage our audience to reach out to us afterwards if you do have any questions on any of the material covered, and if you'd like to discuss this, just fill in the feedback form towards the end, which you will be directed to. Now, today I'm going to be joined by Daniel Afan-Jones, who is a senior partner within Apollo Private Wealth, and Robert Pullen, a partner of Blick, Rothenberg, who is a tax and accounting expert. Both of our panel this morning have a wealth of experience in assisting clients navigating this particularly tricky area from a general investment perspective, but more crucially understanding the different taxation rules that apply to different people, different individuals at different stages of residency. Good morning to you both.
Good morning.
Morning, Ashley.
Daniel, I'd like to start by asking, as a very general overview, what are the main areas you typically find clients are concerned about when they speak to us for the first time from a planning perspective?
Yeah, no, thanks for the introduction, Ashley. We get an array of questions coming in from clients, and we have seen actually over the past kind of 12 to 18 months, a lot of questions coming in from non-dom clients as well. I think the rules changed a few years ago, and that really started to get people thinking that they needed to be thinking a bit more about what they're doing from a planning perspective, and are their offshore assets or onshore assets at risk. We get sometimes a lot of reservations from clients around what they should be doing and what they can be doing, and also if there is anything that they can be doing with their offshore assets. And then we also get a lot of questions around, I've just moved to the UK, I'm a non-dom. What does this mean for me? What do I need to be thinking about going forward, and what are the key timelines?
Fantastic. And Robert, it might be useful just to give a bit more of an introduction as to what issues can arise from not having an awareness of the taxation rules on that side.
Yeah. So, I mean, there are lots of different things to think about, as Dan was just saying, and the main point to be aware of is that once you become a UK resident, you have to pay tax on your global income and gains, and that's the default position. So although someone coming to the UK for the first time might not be aware of the rules here, might not have that many UK assets, most of it might be outside the UK. As far as the UK tax authorities are concerned, they have to file their taxes and make sure everything is reported in line with the UK rules. So the biggest issue that can come up is just not being aware of that and having to get up to speed with a whole new tax regime.
Absolutely, which I imagine is a minefield in itself.
Absolutely is. I think the UK's got one of the longest tax rule books in the whole world, so it's a lot to get your head around.
Well, I think it might be worthwhile just giving a little bit of an overview as to what it actually means to be a non-domiciled individual, Daniel. Ultimately, just setting the scene as to what potential sort of problems they may face when they come to the UK for the first time.
Yeah, sure. So this actually offers a lot of confusion from clients, and I would say in excess of 50% of the clients I speak to get confused with domicile status and citizenship. And they are two very different things. So somewhat archaically and definitely outdatedly, your domicile status is actually picked up generally from your father's place of birth. Now, what that might mean for someone coming into the UK is that they may well think that as they establish citizenship in the UK or get a British passport, then their domicile of a foreign nature goes away, when in reality it doesn't. it also means that people may think they've got a domicile of a country they grew up in, but in fact they don't, because it's not their father's place of birth. So it really is a relatively convoluted area. However, what it does mean for someone coming into the UK is it offers a number of opportunities, right? So you get the opportunity to pretty much cleanly cut your offshore non-UK assets and your onshore assets, and you have a timeline in which you can do that, and across that timeline you have different opportunities to you, which I'm sure Robert will touch on as well as we go through this. So coming into the UK, in the first 3 years of being in the UK, you may well be able to benefit from something called overseas workday relief, and that behind it has a lot of components which may or may not make that possible. But the point is, you do get an opportunity to be tax efficient as a non-dom for the first 3 years in the UK. Following that point, you may not get the opportunity for overseas workday relief anymore. However, you still then have a timeline pretty much up to year 7 of being in the UK, where you can just shield your offshore assets. So pretty much, if you have offshore assets, leaving them offshore, don't bring them into the UK, you're okay to do that from a tax perspective. Sorry, please go on, Ashley.
No, go ahead. Sorry.
The tricky piece comes at year 7, which I'm sure we'll come on to throughout the webinar, but when you start falling into the element of remittance basis, and that really leads you on to your 16th year out of the last 20, I believe it is, in the UK, where you then become deemed domicile and all of the rules change. And that's where we really do strongly advise seeking both tax advice but also financial advice as you go through these stages.
Great. And anything to add on that, Robert?
I mean, I agree with everything Dan's just said, and I think domicile is a uniquely British concept, and most countries tax their individuals who are there either on residence or citizenship nationality. So it's quite common why that misperception might come in. The whole concept of domicile, as Daniel said, is based on sort of like your family background, where your long-term intentions are, whether you're moving somewhere permanently, whether you're choosing to live there forever going forward. It's that sort of concept rather than temporary being somewhere resident just for one particular purpose. So, but the tax benefits of being non-domiciled are very generous in the UK. It competes with countries like Italy and Portugal by having that favourable tax regime, and providing the rules are met and the conditions are met and you do everything correctly, because there are an awful lot of conditions to meet and to pick your way through, then it can be very tax efficient to be in the UK as a non-domiciled individual.
Fantastic. Well, I think it's obviously a hot topic at the moment, and maybe not at the moment with the with COVID restrictions and travelling backwards and forwards. But I think certainly London has always been seen as a very multicultural environment, and we often find that people come from all walks of life from around the world to work and remain in London for a period of time. In that sense, what would happen if I were to move back to my country of origin after 10 years or 12 years even, without necessarily being deemed domicile in the UK at that point?
I think on that point, actually, firstly, the jurisdiction in which you're moving back to has a big impact, and also whether you've kind of repatriated any of those assets to the UK during the meantime. So if you do move to the UK as a non-dom individual, let's say you're coming from France and you decide to move back to France during that period, and you haven't actually become deemed domiciled within that point, or haven't met any of the other conditions which would classify your offshore assets taxable, then typically, and not always, but typically, those assets that stay offshore are okay, and they're not necessarily going to be liable for UK taxes. The problem would arise if you brought those assets onshore during your stay within the UK, and no matter how long. So if you brought them onshore and then they started effectively accumulating onshore, then again, generally these assets are portable when leaving the UK, i.e. you can pick them up and repatriate them to another jurisdiction, but you just should really be seeking advice before doing that, because the tax implications when taking assets back out of the UK, it could well pull up some tax liability for you. And you also just want to be careful about where you're moving back to. Are you then going to face a tax charge when moving the assets into that country, in that jurisdiction?
Great. And I think on that side, you know, when often you hear when you're moving assets offshore, it can be a little bit murky, or some people may be put off by the label of moving assets offshore. Is that something that you typically find, or is that something that can be done regardless of the wealth you have, or regardless of the amounts involved?
I'll also welcome Robert's advice on this, but I think the element of offshore has almost become a bit of a taboo over the years, and I think unnecessarily so. There are, you know, you hear of many stories where people are hiding assets offshore, and they are just illegal activities. And I think there's a line between illegal activities and HMRC approved activities. Now, the element of non-dom and offshore and onshore assets has been going on for years, and it is very much within the rules and regulations of the HMRC, and it's a very good opportunity, as Robert just touched on, for non-domiciles to be tax efficient. So what I always urge my clients to do is you know, if it's a loophole, don't do it. And if it's moving assets offshore, that's okay. Just make sure that you have sought the right advice, and that you are, you know, you're playing to the rules, and that you're just being tax optimal as opposed to trying to seek a loophole in the tax rules.
Yeah, and I mean, just to add to that, firstly, I agree again with everything you said, Daniel, and you know, having assets offshore is absolutely fine. Nothing wrong with doing that at all. I think, unfortunately, the actions of a few has meant that, you know, it gets a bad name, particularly where those individuals don't declare the income or gains properly in the UK, which is really where all of the problems come from. And that's why HMRC looks so closely at offshore assets. A lot of the changes that we've had recently around disclosure and reporting, you know, things like the Common Reporting Standard, where countries share information, all of that means that the revenue here and in home jurisdictions have much more information at their fingertips. They cross-reference, they check, work out whether everything's been declared properly, and that is the thing which causes a lot of issues. But just merely holding assets offshore for very good reasons, you know, commercial reasons, maybe it's a better investment opportunity, or just taking advantage of the favourable remittance basis, the tax regime which the government here are encouraging to attract people to come to the UK. There's absolutely nothing wrong with that. Just make sure you report it properly.
So, well, thank you both for giving me a bit of an overview from both that side. Just to touch on that, Robert, I think for those of people who are coming to the UK for the first time, it would be good to gain an understanding as to what really differentiates paying tax on an arising basis on your worldwide income and assets and the remittance basis, which is a minefield in itself.
It certainly is, and I think I've mentioned, so when you become a UK resident, the default is that you are taxable on your global income and gains. So even if you don't bring that money to the UK, you should be paying tax on it. But if you are non-UK domiciled, and if you claim the remittance basis of taxation, the favourable regime, then your tax liability is limited in the UK to your UK sources of income and capital gains, and only non-UK income and gains if you bring that money to the UK. And the definition of bringing the money to the UK is very wide. It includes obviously transfers of cash to a UK bank account, but it can also be acquiring UK assets, or paying for services in the UK, or using a credit card in the UK and paying it off outside the UK. So you need to be very careful. There are lots of traps to be aware of. But as I've said, if you make sure that you set up your bank accounts properly, for example, if you maintain non-UK investments through your investment portfolio and stick to the rules, then claiming the remittance basis can be very powerful.
Yeah, just something on that as well, Robert, which you mentioned, which I have seen in the past, where people fall foul to the element of raising debt in the UK against offshore assets. So at, you know, things like Lombard lending against portfolios, that can actually become really complicated and penal if you do it against either non-clean or offshore assets, but you're raising that money in the UK.
That's absolutely right. And it's quite common, or it has been quite common up until recently, for a loan to be taken with security on an offshore investment portfolio, for example. The UK tax authorities changed their mind, changed their view on that one a few years ago now, and it means that it can be treated as a remittance of the offshore investment portfolio because it's being used as security. And if that loan is then used to buy assets in the UK, for example, like a house, or just for spending money, that can cause problems. So you're absolutely right. You need to be very careful with any securitized debt.
How does the charging structure work? Because many people have an understanding that they may have to pay a proportion of their income and they offset that, or is it a flat charge from a remittance basis that you would have to pay depending on what your assets essentially are?
So for the remittance, to access the remittance basis, for the first 7 years of being tax resident in the UK, you can claim the remittance basis for pretty much free. There's no charge at all. You do lose your personal allowance, which is the tax-free amount of income that you can receive, and your annual exempt amount, which is the equivalent but for capital gains. They're relatively small amounts, however. So for the first 7 years, it's generally seen as free. After 7 years, so from year 8 onwards, you have to start paying an annual charge, which Daniel mentioned earlier. It's £30,000 a year to access the remittance basis. That's a flat charge. You get to choose every year on an annual basis whether you claim the remittance basis. So you quite often work out, is it better to claim and pay the charge and restrict what tax you pay in the UK, or is it better to just pay tax on your global income and gains? That charge increases to £60,000 per year after 12 years, so from year 13 onwards. And then after 15 years, you become deemed domiciled, which means you cannot claim the remittance basis anymore.
And from that front, as I understand it, it was originally a £90,000 charge that you would have to pay. At what point did that change?
So there have been quite a few rule changes over the years, and there were some changes in 2012 and then more recently in 2017, which is the one that you're referring to, when they brought in the concept of becoming deemed domiciled after 15 years of tax residence in the UK. At that point, the £90,000 a year charge also fell away, which was if you've been here for more than 17 years.
Great, that's really, really helpful on that front, Robert. So thank you for that. And Dan, anything else to add on that front? What you tend to come across from a client advising perspective?
Yeah, no, that pretty much covers most of it. I think from a client advising perspective, it's really just optimizing these timelines. So at what stage are you in the UK? What's your tax treatment going to be at that year? And actually being very mindful of what's approaching. And I think as you start to approach that year 8, or as you start to approach that year 13, or as you start to approach that year 16, just being well aware of what the impact is to you and whether you need to do any planning before that date.
Great. And from an inheritance tax perspective, I believe this is obviously a very, very complicated area. Certainly it's very relevant when speaking to non-domiciled individuals, and particularly as they start to become deemed domicile. Robert, would you be able to give me a bit of an understanding as to how the inheritance tax links into the overall understanding of domicile planning?
Yeah, absolutely. And inheritance tax is one of those taxes which works in a slightly different way to, say, income and capital gains. So if you've got a non-domiciled individual who's in the UK, their UK inheritance tax exposure is limited to their UK status assets. So those are things like UK property, UK shares, so shares in UK companies or debt, and then assets which are physically located in the UK, like cars and clothing and jewellery and that sort of thing. There's no need to claim the remittance basis to access that. That's an automatic rule. Your inheritance tax exposure is just limited in that way. Once you become deemed domiciled, so after 15 years of being tax resident here, that changes. And suddenly your worldwide estate, your global assets are within the scope of UK inheritance taxes. And the UK inheritance tax rate is 40%, which is a relatively high rate. The 0% threshold is £325,000 per person, which is, again, when you think about it, a relatively small number. It hasn't changed that much over the last few years. In America, for example, it's around $11 million of exemption that you can get. So compared to other countries, the inheritance tax regime is quite penal here.
Great. Well, I think there are other challenges that come as a result of being a US citizen, which I think is going to be worth another webinar in itself rather than trying to address it. So that's all been really great from both of you. Just on one final point, obviously you both discussed in fairly decent detail about the amount of sort of offshore, obviously using that as an optimal chance to try and manage any tax liability quite favorably. What role could trusts have in essentially minimizing tax liabilities for individuals who are looking to return either back to their domicile of origin or indeed stay in the UK but keep their assets offshore?
Yeah, so, oh, Daniel, go ahead.
Yeah, sure. So, look, I think almost a bit like the taboo of offshore onshore assets. I think trusts as well have become somewhat of a taboo over the years. And, on the flip side to that is they also become almost a default position for people, and sometimes unnecessarily. Now, I think in terms of protecting one's estate, whether that's from IHT or relocation, there are a number of different things you can do, and it doesn't necessarily mean the default position is going to set up a trust. And in fact, what you can find is by setting up a trust to try and solve one problem, you create a number of other problems in the process. And I think, without going into this in too much detail, we've seen properties in trusts be a kind of key issue around that point over the last few years. Now, there are certain trusts that can be really beneficial to a non-dom individual before becoming deemed domicile in the UK, such as something like an excluded property trust. But again, before setting this type of trust up, it just makes sense to really sit down, take stock of your tax position globally, and see what assets are actually going to fall liable to UK taxes and what aren't, and whether or not the trust makes sense to that global position.
And anything else to add on that, Robert?
Yes, so there are definitely tax advantages to having a trust in place, especially for non-domiciled individuals. So, for example, inheritance taxes, the term excluded property trust means that the inheritance tax exposure is limited to UK cited assets. And that's the case for a trust even after someone becomes deemed domiciled here. So again, using it even for just that purpose is very tax efficient. But you have to make sure that the trust fits family circumstances, and it's not something that can be rolled out for every client situation. You have to make sure that it's right for you, right for your family, so that it protects you for the longer term, not just to fix a tax problem.
Fantastic. Well, thank you both very much for your time and for your expertise today. I definitely think there's a lot of information on there to digest, which hopefully a number of our attendees will find useful in navigating and really simplifying the tricky landscape, which is planning for a home from home for non-domiciled individuals and their families. Now, I think we've done quite well to keep it as succinct as possible, but obviously there is such a range of number of topics that we really haven't had any time to cover off today or even delve into. If you do have any questions on anything that we have discussed, then please let us know via the feedback form. But again, in the meantime, thank you very much for joining us today, and we look forward to seeing you next time. Thank you both.
Thanks, Ash.